Hello and welcome to the Pender podcast. I am Sarah Wildman, Director of Institutional Relationships at Pender, and today I'm pleased to be interviewing Dave Barr, President, CEO, and Small Cap Portfolio Manager and Coffee Aficionado. Today we'll look back on the past 10 years of Pender, highlighting key events and stories, the Pender culture, and of course, investing. And for those of you who listen to the end, Dave will share his latest book choices for you readers out there.
This podcast is for information purposes only. It should not be viewed as investment advice or as an offer to buy or sell Pender's funds. Our funds are not guaranteed, and any discussion of past performance is not an indicator of future results. Any opinions expressed are as of the date of this podcast and are subject to change. Pender may not necessarily share the opinions of our podcast guests. More important information can be found on our website, PenderFund.com/disclaimer.
Hi, Dave.
Hi, Sarah.
So let's reminisce a little bit. Pender began in 2009 in the wake of the financial crisis. In hindsight, it was a great time to launch an investment firm, but it was not an easy time. What are a few key events over the course of these past 10 years which really, truly stand out for you?
When you look back, 2009, we probably couldn't have timed it much better. I think we did miss the bottom by 3 months, and we launched in June instead of March. So I still take full responsibility for that. When you look at it and where we've come in 10 years, there's obviously events that stand out along the way. But I mean, what really stands out to me is from day one, it was really focusing on a couple key things, and it was investing the right way, despite any pressures that were out there in the world or what was going on in the markets. It was always tuning that noise out and focusing on each individual company we were putting in the portfolio, making sure our investment thesis was always intact, assessing what we thought the value of the business was relative to where it was trading. Because what we knew is if we did things the right way and we built the track record, which we felt with our process we had a good possibility of doing, we were going to achieve our goals over the next 10, 20, and 40 years. And so really, when I look back, it really, the decisions we made along the way really supported that. And there's obviously a lot of key things along the way. It was, building out a sales team, which sought out and built relationships with investors who, bought into the way we did things, who believed in the Pender way of investing. And it's so important to have alignment between the investment process and the investors in the fund. And every day I feel very fortunate about the team we've built here and the relationships they've built with the investors in our funds. The second part is building out the investment team, and it was interesting in the early days because we joke around it was me looking in a mirror making investment decisions. But over the years, we brought Felix on board in 2013. And then subsequently, the investment team's got 12 people on it today. But really building out that depth and analytical rigor internally really has ramped up what we're able to do on the investment team. On the investment team, our job is two things. It's research and making decisions. And decision making I think is always better when you have a diverse group of people who are having input into what you're doing. And certainly one thing here is we all don't come from the same high school. A lot of us have varied experiences in life, have taken different paths to get to the investment industry and here at Pender. And I think that really contributes to how we view the world and the types of investments we make, and the decision-making process itself, which is fundamental to generating returns. So, and then the third part of it is the operational discipline we have here. And I think everyone, when you start a fund company in 2009, like honestly, Canada needs another fund company like it needs a hole in the head. And building out a flexible operational team that allowed us to get to break even quickly. But then also introduce the operational stability, compliance, and back office support to provide the fundamental, the pillars of the business so that we can execute on this for the next 40 years.
Moving on a little bit from there, I do think it's safe to say that 10 years ago, you may not have pictured Pender exactly where we are right now. When you look back, are there consistent key factors which have contributed to Pender's growth?
Yeah, we didn't have a 10-year business plan. We had a kind of a 5-year guideline. And you're right, it looks, in any business, the future always looks way different than what you would have forecasted when you started it out. I just going back to it though, it was really focusing on investing the right way and finding the right people to join Pender over the years. And it's what we've done for the last 10 years. It's what we're going to do for the next 20 years. And that really is what drives who we are today.
Let's elaborate a little bit more on investing the right way. You always talk about the Pender Edge and how it has 3 core components. For our listeners, please define this edge and walk us through each component.
Yeah, I mean, you can sit there and read the Globe and Mail or any kind of business publication and realize that active investing is a terrible idea, and everybody should be invested in ETFs and index funds. The reality is there are sources of alpha and advantage in the markets, and they boil down to 3 key areas. First is, can you have an analytical edge? And that's having a unique insight over other investors out there. And we've traditionally focused on the small cap space where there's lots of opportunity for analytical edge. There's not as many participants. There's less capital chasing companies. So for us to go out and talk to customers and meet with the business, the company, and talk to people, the employees of the company, and then go talk to the competitors, we can formulate an opinion of the business that a lot of other people may not have. So the first is analytical edge. The second is behavioral edge. And this is very attuned to the public markets because people are totally irrational, which is funny because one of the key assumptions of the efficient market hypothesis is everybody is rational. So there goes that out the window. The behavioral approach is just being able to have conviction in what you know, so that when everybody is losing their marbles and stock prices are going down, you're able to buy the stock. And we over the years we've seen this time and time again. We had the pigs crisis in 2011, where Greece was leaving the euro, and we had U.S. debt getting downgraded, and there's a big sell-off in the markets. And at that point in time, we took our small cap fund from 39% cash down to about 5% cash, because we had the behavioral approach to actually recognize the fundamental value of our businesses had not changed. There was just people acting silly in the markets, and we took advantage of that. And that's held true over the years. I mean, that goes right through to December of last year, where we're at the investment team meeting, and I'm right before Christmas. I'm like, what's everybody's top 3 ideas? This is the time to get aggressive. And sure enough, I mean, most of our equity funds, we are fully deployed of our cash by year end. We're low single digits, if not 0, because that was the opportunity. Just being calm, being rational when others around us were not being so. So that behavioral approach is really key, and you see it. It's great when you have this massive market volatility, which Felix will always call this the tide goes out investing. It's just you just walk around and pick up fish. What happens more in the markets is there's companies are always sharing news releases, and in situations companies can fall out of favor for sometimes very good reasons and sometimes not so good reasons. And so behavioral approach, it certainly works in individual stock selection, and trying to identify kind of needle in the haystack opportunities, as Felix will talk about. The third, and I mean, this is what I hold most firm at Pender, is the organizational edge. And what does that mean? I mean, it's great to talk about having a long-term investment perspective. It's great to talk about having this deep analytical approach. It's great to talk about being aggressive when everybody else is really fearful. But you need a company that's actually structured to support that type of activity. And it's if you're a public company and you're worried about what your operating results are going to be on the next quarter, it's really hard to be doing the things on the investment side to actually fulfill that longer term, the behavior, take advantage of the behavioral aspects of the markets, as well as dive in on the analytical side. So really being an employee-owned shop, being the president and largest shareholder, it's the way I behave. So it's the way I view the world, and it gives me the ability to let that percolate right through. There's a coffee quote for you, Sarah.
Nice.
Yeah,
well done.
Percolate right through Pender and everybody on the investment team, and the sales and the operations teams as well. It's I think what's great is we've had that approach, bought into right throughout the organization.
So continuing on that investing theme, you and the team consistently mention that there are two types of companies in the market, those with problems and those that will have problems. Can you explain this, and with an example if possible?
If you go through business school and you're reading case studies, you tend to hear about companies that have done really well and what makes companies successful. And people don't write books about how hard it is to build a company. And Phil Knight wrote a book recently called Shoe Dog, and it talks about his journey building Nike. And anybody who looks at Nike just thinks, that was such a great company, a wonderful brand, and gosh, how easy would that have been? Like, what a, they sure got, that must have been fun and easy. And, you read the book and it might've been fun. I think I read some glimpses of fun from Phil, but it certainly wasn't easy. And it really demonstrated how hard building companies are. And coming from the private equity world, where we've sat on lots of boards of companies, we've watched these companies get built in real time, and we've voted to shut companies down almost. And at the 24th hour, the CEO comes in with a second mortgage on his house to save the company. And product doesn't work, so you have to lay off a team that's been responsible for it. Like, there's all these hard decisions companies are making on a day-to-day basis. And from the traditional public markets investor on the outside looking in, you don't see all this stuff. So all you see is the financial results and the spin from the marketing department writing up the press releases. So you start to think it's a little bit easy, and we know it's far from easy. And what that does is it gives us the confidence to know that there's good companies, and they're going to have difficult periods of time. And so what we spend a lot of time doing is trying to figure out who those great companies are. More exciting, we try to figure out early on in their life cycle who those great companies are going to be. Because if you can get them early with a big long runway addressing a big market, that's where you can really compound capital for a long period of time. But understanding where you think those great companies are, those really good companies are, and then when something bad happens, being able to assess pretty quickly if it's short-term in nature. So is it just a blip, or is it a fundamental breakdown in the business? And if it's a short-term blip, that's really where we like to get involved in companies. And I think we can go through our portfolio and look at a lot of these companies and see where our entry point, and it's usually closer to 52-week lows and 52-week highs.
So we're very fortunate to have wonderful clients and partners who have been with us for all or part of the last 10 years, and many may be listening. What are a few of the core characteristics of our clientele? I
think where we've been very fortunate is I've had the opportunity to meet with a lot of our investors over the years. And what really resonates with me is their engagement in the process. It's, I've also had meetings where people talk about the numbers and the performance. And, fortunately, I've had a lot more conversations about the process and the way we do things. And I think, because we love talking about it so much, if you're not really invested in the Pender process and the way we do things, you're probably not going to take a meeting with us, because we're going to be quite boring. We think boring's good. And for us, it's the more we talk about the process and the more we can attract people on the way we do things, because we know the results are going to vary over time. There's going to be periods of time where we do well. There's going to be periods of time where we don't do very well. We're obviously trying to, make sure they're all the good periods as opposed to the not so great periods. But having people who understand the process, it creates a much better experience, because the last thing we want is, when one of our funds is off 10% and then people are redeeming and they miss out on the 30% uptick, which comes after the fact. So it's really people who are understanding the process and involved in it, and just less focused on the performance of the funds we manage.
So let's move on to talking about the Pender team. I have to say, but of course I'm biased, that Pender's employees are an excellent group of people. How have you and others within the firm built and continue to build the team?
Our entire industry is built around people. It's a people-based business in terms of both building relationships and the intellectual capital required to analyze companies and build portfolios. Much like the technology companies we invest in, I think that's given us a bit of an edge to understand as we build out Pender, very much like the technology companies we've helped build and support over the decades. People are the number one asset we have, and even more importantly, people who are smart, hardworking, ethical, and contribute to a positive culture. Culture in itself is hard to define, and it's kind of one of those things when how do you know if culture is good or not? Well, if you see a good culture, you know it. And for us, there's so many talented people in the investment and financial services industries that fit the super smart, super hardworking, highly ethical. Finding the people who are going to fit in the culture. And one thing we always talk about here at Pender is building out the farm team. And what that means, it's build relationships with people in the industry who you think might be good additions to Pender in the future, because anyone can come in on a job interview number one and impress you. Well, not anybody, but a lot of people can. It's second job interview, or it's like second or third round. People can keep up a charade and pass through the culture test. But if you've been having coffee with someone for a year or two before you actually join, then that's a much better indicator that someone's going to be a positive fit over the years. And it's building relationships and understanding people for a longer period of time to make sure that they have that the most important hurdle for us, which is fitting in at the company and doing things the Pender way.
So in that vein, you've recently referenced a book by NFL GM Michael Lombardi, Gridiron Genius, and it's an interesting study on what makes great organizations tick. I have two questions on this. So how does this pertain to Pender as a firm? And then second, how does this also apply when evaluating companies to invest in?
I was made aware of Michael Lombardi on a podcast I was listening to, a Capital Allocators podcast from Ted Saydays. And in the course of the podcast, Lombardi said something which really resonated with me. And what he said was, I think when he was talking to Bill Walsh, because he worked with the 49ers, and they were talking about what teams could potentially win the Super Bowl. And Bill Walsh said, well, I only worry about, I think it was 8 teams. There's only 8 teams that have a chance of winning the Super Bowl. Well, why is that? It's like, well, because they're the only ones that have the organizational buy-in and culture to win the Super Bowl. And what that meant is all the way from ownership to the GM to the coach to the players, all bought into the process 100%. And so that culture and alignment is key for success in sports, much as it is in business today. And kind of tying that back into the 3 sources of advantage in investing. I mean, that totally speaks to organizational edge. It's having everybody at the company aligned and driving in the same direction and buying into that process. So when he said that, I mean, that just resonated for me about the organizational rigor needed to be successful, and it translates both from sports to investing and business. When looking at companies, Lombardi also worked with Belichick, who obviously probably the greatest coach of all time, great leader, and it's when looking for companies, really one of the key areas we focus on are founder-led companies. And it's because, founders start companies and they have a long-term clear vision of what they want to be doing. And that enables, when short-term troubles strike, for the founders and the companies to make decisions which are beneficial to the business long term. And if you don't have that long-term vision, if you're driven more by your quarterly performance metrics and Wall Street analysts, it becomes a lot harder to stick to the plan on where you want to be. So much like, so for us, it's really, it's very consistent with trying to find these founders who are going to build businesses for the long term and what the characteristics are of those types of people.
So moving into the future, and don't worry, I won't ask you for your crystal ball. What do you think are the biggest challenges facing the investment industry today and beyond? And how is Pender positioned to navigate these challenges?
The challenges in the industry today, I mean, what the big trend we're currently seeing is this shift towards ETFs and passive management. I think in the US, they just surpassed greater than 50% of the assets are passively managed in the United States now. And for a lot of active managers, this is really scary because basically active managers are getting redeemed and the flows are going into passive. And there's a positive feedback loop involved here because if you sell an active manager who's probably not invested in the index and buy passive, the stocks the active manager owns are sold, so his performance suffers more, and that capital then buys the 11 stocks in the top of the NASDAQ 100 or S&P 500 disproportionately because it's all market cap weighted, and then those stocks go up. So then the performance delta is even, every time this happens, the performance delta increases even more, making passive management look that much better than active management. The reality is I think in business, there's generally two strategies you can pursue. You can be the low cost producer, and that's the index ETF world. And not only is it low cost, I mean, there's some ETFs now where you get paid to invest in them. And then the other side is how do you differentiate and do something a little bit different? And that's really the approach we've taken is we think there's parts of the market we can exploit with smaller, nimble strategies where we can have an analytical edge and we can drive alpha. And fortunately, to date, we've been successful doing that. I think the big challenge is the big firms in the middle, which claim to be active managers and look exactly like the index. So their index funds charging fees. I mean, there's a lot of people who made a lot of money doing that for a long time. I'm glad, those jobs are probably, going away at some point in the next 5, 10, 20 years. The other aspect is, where we see potential disruption. And, we invest a lot in technology, and, we have a whole team here looking at emerging technology companies. So I think we're fairly topical on these types of trends in the industry. You look at technology over the last kind of 30 years has automated a lot of blue collar jobs. And, the next step is technology is going to automate a lot of the traditional office jobs out there. Software development, and particularly in the financial services industry. The way we look at it, though, is we have to focus on, how can we utilize these things to make our investment process more robust? Because people are going to be necessary, maybe not as many, but it's utilizing the disruptive technologies to make our investment process more robust and complement what we do. And that's the advantage we have, where we see a lot of these things probably earlier than a lot of other asset managers and can adopt it into our process.
On to the reading section. Which books do you and the team feel are the must-reads for investors, as well as those who are interested in building businesses, leading teams, and making decisions?
There's so many great books out there that you can learn from. You can go into Felix's office, and if you need to learn on any topic, just ask him, and he can point you to the book and the chapter you need to read. I think, as we're talking about our 10-year anniversary here, we originally got started in private equity and venture capital. And for me, kind of following Berkshire Hathaway and being a value investor, I always found it was kind of challenging because we'd be looking at these earlier stage technology companies, and I'd be doing a deep dive on them, trying to really figure out the industry dynamics in the marketplace, and then what would the customer demand be like, and was it a real ROI? So what was the value proposition of the product, and was there a potential sustainable competitive advantage there, and could the management team actually deliver? And and then tying that in, being a value investor, particularly in 2000 when the technology world's going wonky, there was definitely a disconnect. And that disconnect was closed in 2003, 2004 for me, when I read Phil Fisher's book, Common Stocks, Uncommon Profits. And that was like one of my key light bulb moments. And I think I read it all night. I probably read it over the course of 24 hours. Because he was someone who was active in the public markets. And at Pender, we had been more active in the public markets than the private markets in the technology space. And he was basically applying a deep private equity style due diligence approach, running a really concentrated portfolio of 10 stocks. But he was also looking at these smaller growth companies in the public markets. So it married for me the two approaches where we were digging deep on these technology businesses, but they are also publicly listed and building out a portfolio. So that was probably for me one of the most influential books, and certainly a key influencer on where we are today at Pender. I think the most interesting books we read now are the books about mistakes, or companies that have it hasn't been easy. And that's, I mentioned Phil Knight's book, and Ben Horowitz wrote the book Hard Thing About Hard Things. Anyone who thinks building a company is easy should go read that book. And then there's other books, a company called $1 Billion Lessons. I think we've recommended in the past. If you're ever thinking of investing in a company that's growing through acquisition, definitely read $1 Billion Lessons before you do. So I could go on and on.
I think it's a pretty good list for most people to certainly start with.
Yeah.
So moving on from there then lastly, what's the current book choice and why?
Yeah. The most recent one was Michael Lombardi's book, Gridiron Genius. Really, I was fascinated with. It talked about, vision, leadership, culture, and how that drives strategy and tactics. And it's obviously applied to football, but I always find, I love sports, and I always find, reading about other practitioners in different spaces, there's always parallels, and I think it's more important to focus on principles than individual tactics or whatnot. It's the core principles and mental models you develop which allow you to identify where the opportunities are in the world today. Well,
thank you, Dave. And thank you very much to the listeners. If you'd like to sign up for Pender Podcasts, please visit our website at penderfund.com/podcasts. Until next time.
Thanks, Sarah. And happy anniversary, Pender.
Pender is an independent, employee-owned investment firm located in Vancouver, British Columbia. Our goal is to protect and grow wealth for our investors over time. To achieve this, we seek to understand the quality of a business or security, obtain more value than we are paying for, deploy capital in flexible mandates, and mitigate downside risk. We have a talented investment team of expert analysts, security selectors, and independent thinkers. They manage a suite of niche investment funds with active, concentrated portfolios of value-based, occasionally contrarian investments. We invest in our funds too. You can learn more at PenderFund.com.